Well, they tell you to never read the comments, but that's what we're doing today. And in fact, you can get some pretty good unfiltered advice on retirement and get the reality of the situation by reading the YouTube comments. We got some comments today we're going to pull from a video, break them down, get Ryan's thoughts on them, and find out what's fact, what's fiction. Welcome into Perfect Game Retirement. I'm Ben George with Ryan Ledden at Black Oak Asset Management. He is a certified financial planner. Ryan, I'm sure you've learned through the years, you got to stay out of the comment section. Doesn't matter where you are, especially with social media. Over the last 20 years, there's rarely anything good in the comments.
Yeah, can be a rabbit hole of terrible advice or wisdom, if you will. There can be some good, and we're going to talk about some of those today. But man, you can get caught in the weeds of comment sections because anyone under the sky can put a comment in. So you just don't know who that person is who's making that comment.
Yeah, it's interesting because with retirement videos, we're going to pull some comments that came from a recent video on another channel. But I think it's interesting because you kind of hear some real fears, some real frustrations, and you actually hear some strategies that people have used to get to retirement and, solve issues that they have. So it's not just all, people just trolling in the comment section. There's actually some interesting stuff within this. So that's what we're going to talk about today. And look, if you have any questions specifically, any thoughts, right? Reach out to a professional. Ryan, you can get on his calendar at speakwithryan.com, but you want to begin talking about some of these things, some of these fears, some concerns that you have, and start working with the plan to get there. But let's jump into these. And there's a couple of different categories here. Let's start with Social Security timing. And this comment I thought was really interesting. We took Social Security at 62 to prevent a sequence of returns risk, which we've heard about and talked about here, I think, Ryan, a little bit. Mm-hmm. Social Security covers all of our expenses. We have a substantial 401k, and I retired in 2021, and it worked out perfectly as the market tanked right after I retired. We didn't touch our 401k. So what do you think about this timing strategy he talks about here?
Yeah, I mean, this is a good comment. It's a great comment, actually. So, delaying Social Security is not always the answer. Sometimes taking it to 62 is the answer, which for this person, it's definitely worked out. And just if you're not familiar with, you're right, we've talked about it before, but if you're not familiar and not sure what the sequence of returns risk is, it's basically, because again, you're going to have rates of return, positive or negative, depending on the year. And sometimes people, if they retire and then there's a huge correction, like in 2022, which this person is commenting on. So 2022 was a rough year. So from a stock market perspective and a bond perspective, because bond prices went down because interest rates go up. They're always opposite of one another. Like we talked about here, it's always a seesaw, back and forth, back and forth. So 2022, every index was down and prices were down. So and bonds are sometimes seen as quote unquote safer. They have risk. It's just different risk. It's not market-based risk. It's interest rate risk and then duration risk. Anyway, I can get into all the different risks. But sequence of returns risk is, let's say someone retired in 2022 and then the market has a 20 to 25%, sometimes even closer to 30% pullback. Well, that retirement plan is going to look way different long-term because you're taking money out when the market is down. So again, that goes back to me really wanting people to have a really overfunded emergency fund when they get to retirement. I think that's imperative so they can pull from safer vehicles versus pulling money out of a 401k or IRA or whatever it may be. So this person, they wanted to take it at 62 and it covers all their expenses. So, hey, more power to you. If you are taking a Social Security income at age 62 and it covers all of your expenses, I mean, even if you had maxed out Social Security, I mean, you're taking a 30% reduction at 62, again, which is fine. So you must have had a really good working career and still taking a 30% reduction, and that still covers all of your expenses. That's fantastic, great for you. So in your case, I'm in line with that person. I think that's a great comment. So I think it's good. Sometimes the trade-off is, okay, you kind of lock in your Social Security forever. Now, there's cost of living adjustments each year, not guaranteed, but usually the government gives you something that 1, 2, 3%, even maybe higher cost of living adjustment is going to be multiplied by that factor of a smaller Social Security benefit. So just know you're kind of locking yourself in. But in your case, this sounds like it's worked out, and I'm not sure what a substantial 401k is, but sounds like you probably have a good 401k. So that's where extra income, if needed, will come from this 401k.
Yeah, good comment. All right, how about this one on healthcare costs before you get to Medicare? I thought this was interesting. Besides underestimating healthcare costs, a lot of people also underestimate their ability to pay for healthcare costs before Medicare, especially higher earners. 2K per month for two people for us with some level of employer retiree subsidy. I budgeted for it for many years ago, and I'm still sucking it up for 7 years until Medicare. What do you think about this? About helping people that are trying to fill that Medicare gap between retirement and 65?
Yeah, it's a real thing. I mean, that's probably maybe the biggest concern for people, or at least it should be, of where is my health care coming from? How much of those premiums going to be, and what kind of coverage do I have? So, sometimes depending on your employer, sometimes if you work for a full 30 years and you're a pension employee, a lot of times you can take that health insurance benefit and then until you get to 65. So that's not for everybody. So if you worked in the private sector and you don't have access to a health insurance plan from your employer, then you're on the hook for it. So you need to know what that's about. Trust me, I'm a small business owner, so I know what large health insurance premiums are. So for some people who worked in the corporate world, then you may not really realize how much these potentially could be. And they're means tested a lot of times. So that meaning the more your taxable income is, the higher your premiums are going to be. So there can be an issue there. You just have to know, as long as you know going into what those premiums could be and the type of coverage you're going to have, that could be a big deal. Now, obviously, you're saying they got 7 years until Medicare, so good for you to be able to retire that early. Just know you got to bite that bullet, for the next 7 years on a monthly basis to pay for those health insurance premiums. So sometimes we tell people if they want to retire, earlier, sometimes getting to 63 and a half kind of bridges that gap between when you retire in age 65. And I say 63 and a half because you can have COBRA for 18 months. So if you leave an employer, you can have that employer plan. Essentially, you just have to pay the premiums on those. So it can't be subsidized at all. So that's one area to kind of bridge a little bit of a gap between retirement and 65. But this one, you got a lot of years to go, but that's okay. As long as you have a plan going in and knowing it, more power to you. Just know that there's going to be a cost there for those of you retiring before 65.
Yeah, got to address that Medicare gap. Again, speakwithryan.com to get on Ryan's calendar at Black Oak Asset Management. All right, let's talk about this comment from someone about that anxiety to spend money in retirement. And it's, psychology is a big part of what you do, Ryan, and kind of how you work with clients. So what's your thoughts on this? I fear in retirement that my wife will be so afraid of spending any money because we are not working anymore. She is very frugal now, and without a paycheck coming in, I fear she will become even more so. Right now, we are saving, investing about $130,000 a year out of our $180,000 a year take-home pay, which sounds pretty good.
No kidding.
And she is even afraid to spend money now, even though we're able to do this. So, psychology, a big part of this. How do you help clients get more comfortable with spending money? Because they seem to be in a pretty good position on the surface.
Yeah, I mean, good grief, good for you, saving 130K out of 180. That's unbelievable. But I do see an underlying problem there. Like you said, the psychology of money, sometimes it grips people with fear, and you can't let that happen. So again, we've talked about the psychology and the mental part of dealing with money. That's where an advisor comes in. That's where I think we earn our keep. Because we help people with the psychology and the mental side of it, but also the psychology when markets are not doing well, how we educate people and take them through a plan. So I think, again, a lot of these things go back to having a plan. So if we can show a plan for your wife to show that, hey, this money is going to last, and the chances of you running out of money are almost slim to none. So if she can maybe see that, even if you, because we can do adjustments to a retirement income plan, you can do where returns are terrible, they're way below average returns, And so maybe that just painting a worst case scenario and still being successful, maybe that will give her the psychological peace of mind that she may need to do this. But it does. I mean, you feel like you don't have that income earning anymore, and sometimes it does the opposite. Sometimes you hear people spending more in retirement, but then you hear some people who won't spend anything because they're just terrified of running out of money. And it sounds like this is the case. But having a plan and running those scenarios of a worst case scenario and still being successful, hopefully that will help.
Yeah, that will be a big help. All right. Here's a good comment, interesting one, Brian. I think, a lot of times we focus on, or just conversations around money, talking about retirees and couples and that sort of thing. But this comment I thought was good because it says there are more and more of us single, and that needs to be addressed. Not everyone is married. So what are some of those unique challenges you're going to find from a single retiree as opposed to someone that's married?
Yeah, I mean, some people are entering into retirement single going in, or some are married going in, and they end up being single or a widowed. So, because the statistics show, and we've done a lot of seminars for widowed women or divorcees. It's a common theme. So, yeah, single retirees. There are, from an estate planning standpoint, is very, very important. Not that estate planning is not important for married couples, but a lot of times married couples, you're each other's beneficiaries, or your accounts are jointly titled. So that's an easy kind of transition from a money standpoint. It's not an easy transition mentally and emotionally, but it is from a financial standpoint. Things just kind of move over into their name. But again, when you're a single person, you have some things to think about. Again, estate planning, like who is going to be getting this money? Is it going to be the next generation down? Do you have kids? Have you always been single and don't have kids? Okay, so if that's the case, who's going to be the beneficiary on your retirement accounts or the money that you do have? Is it going to be a person? Is it an entity? Is it a charity? So you really want to have your estate plan buttoned up and know who you have that trusted person to be your, medical director, financial power of attorney, all those things you want laid out. So an estate plan is always important, but very, very important for a person who is single. So yeah, you want to take, taxes are different. You're in a different category from a marginal tax rate. Sometimes as a single filer, it's easy to be in a higher tax rate. My dad, went from being married to a single person because my mom passed away. So not only did he lose his spouse, he jumped to a higher tax bracket because how the brackets work. Because he's a pension guy and Social Security and any 401ks that he has, it's going to put him in a certain tax bracket. And sometimes the tax bracket's a little bit more lenient for married filing jointly. So I get it. There are some new things when it comes to Social Security. That may be a little bit of an easier decision because it's just you. So hey, when do I want to take this? When it's married filing jointly from a Social Security standpoint, you do have some more options. But yeah, so as a single filer, there's some things that are I shouldn't say way more important, but really you have to make sure you're buttoned up. But then from a Social Security standpoint, it's more of when do you want to take this?
All right, one last comment here I pulled, Ryan. I'm going to get your thoughts on this one. This guy said, the scary part is giving an advisor 1% of your hard-earned money for something you can learn on your own. Now, I know a lot of people on YouTube trying to learn more about financial planning or retirement planning. That's why we do the show. But how would you respond to someone that says they can do it themselves and they don't really see the value of paying for that advice?
Yeah, I mean, if you don't see the value, I always tell people, like, you shouldn't see us as a cost. You should see us as a value add. But yes, do advisors charge something, whether it's a 1% or a flat fee, or I've seen fees way higher than that. So you just have to have someone in your corner, an advisory team, as a value, because there's so many components of what's going on. Just if you're just looking at an advisor as a 1% cost and you're trying to beat the market by 1% to justify their costs, you don't need an advisor. You shouldn't hire one because you're going to nitpick fees all the time. And it's amazing what people will pay for and what they won't pay for. They'll and we're going through it right now. We're doing a Disney vacation. You'll spend, over 10 grand on a Disney vacation like that, but, paying 10 grand over the course of a year for financial advice and tax planning and estate planning, that you cringe at. So anyway, it's funny what people will pay for. So yes, there's a lot of DIYers out there. You can go, and hopefully some people are watching this to help their DIY case, and that's fine. There you can go online all day long. I mean, there's knowledge everywhere, but the wisdom part of it, the wisdom part is how it applies to you. There's knowledge everywhere, and there's just information overload out there. So how does all these things apply to your situation, and how it works best for you? That's the wisdom part. And if you don't want to pay for the wisdom, then that's okay. We are not for everyone. Advisors are not for everyone, but I've seen it be very, very successful for a lot of people, and they see us as a value, not a cost.
Yeah, I think what you said there is so important, because like these comments on YouTube, wherever you're finding the comments section, they can spark some really good conversations. We've had some today, but you shouldn't build your retirement based on someone else's thoughts and their replies. So you want to have a plan for yourself, and be able to know what wisdom you can apply to yourself in your plan moving forward. And that's, again, what a financial advisor can help you with. And Ryan is a certified financial planner. You can get on his calendar at speakwithryan.com. So good stuff, Ryan. I thought that was a little bit of a fun, unique way to kind of take a look at what you do every day, but some really good comments here. And if you have one for us, drop a comment down below the video as well. We'll take a look at that. But thanks for being here. Thanks for watching. And please make sure you subscribe. Take care.